All right, guys. So we're gonna ask ChatGPT what's going on. Our main source is gonna be ChatGPT. We're just gonna get some simplified form of understanding. I'm reading a new book, and this is gonna be the book I'm gonna focus on. I'm not even gonna read anything until I finish this book. I've been reading a lot of things. Of course, when I do my chapter by chapter readings on YouTube. Speaking of that, like and subscribe, guys. Please, it'll really help. Again, I think it'll benefit you if you watch some of the stuff that I'm trying to relay. But so this is on George Soros. I don't know if you guys know. He's one of the most infamous men when it comes to men of wealth. He's infamous. He's said to have destroyed some economies, some third world countries' economies himself. He's a very, very wealthy man. He's said to have lived in parts of the world that was occupied by Nazi Germany. He's said to have been a boy when someone in his family, whether it was his grandfather or his father, betrayed some of his Jewish people and turned them into the Nazi regime. Now he lives in America. I'm not sure where this guy's at, actually. He's very old. If he might be dead, I'm not even sure, but very powerful man, very influential when it comes to politics in America. Has his hands in a lot of things throughout the world. Supposedly he's pushing the woke mind virus. He's trying to demasculate men. He's pushing DEI. Andrew Tate mentioned him as the one trying to bring him down. Supports a lot of the left, the democratic side of our politics, and maybe all over the world. He's said to be influencing immigration, be funding a lot of things that nobody really knows about, unless maybe you study it. So this is just his book that he wrote called The Alchemy of Finance, and some ideas that I've read so far, and I'm still in the introduction, which he says the introduction in his new he re-edited it, the latest edition. He said that this new introduction to the previous edition it consists of the original first chapter and some changes and revision to the old introduction. So he has some interesting ideas thus far. Freaking no space right here. I'm not trying to block the camera. That seems pretty good. And so we're asking ChatGPT, what is George Soros's theory of reflexivity? Reflexivity. Shout out ChatGPT. So we'll just read what it says. George Soros' theory of reflexivity is a concept that explains how perceptions and realities interact in financial markets and social systems. It suggests that market participants' biases and beliefs influence reality, creating self-reinforcing feedback loops. So perceptions and realities interact, how they interact in financial markets. So you could perceive something, but doesn't mean it's necessarily reality. So his theory of reflexivity is a concept that explains how perceptions and realities interact in financial markets and social systems. It suggests that market participants' biases and beliefs influence reality, creating self-reinforcing feedback loops. So key ideas of reflexivity. Number one, cognitive function versus manipulative function. Cognitive function refers to how people try to understand reality. Manipulative function refers to how people act to shape reality. Hence, maybe their perceptions versus reality. So cognitive function refers to how people try to understand reality. Manipulative function refers to how people act to shape reality. These two functions interact, meaning that perceptions don't just reflect reality, they also help create it. And he mentions that. So, number two, self reinforcing and self correcting cycles. When market participants hold a belief that influences their actions, those actions can change the underlying reality in a way that reinforces their original belief. It's called the boom cycle. So it's that idea that Euthyphro problem, when Socrates asked Euthyphro, this is something good because the gods love it, or do the gods love it because it's good? So self-reinforcing and self-correcting cycles. When market participants hold a belief that influences their actions, when they hold a belief that influences their actions, those actions can change the underlying reality in the way that reinforces their original belief. However, once the belief diverges too far from reality, corrections occur. So we got the boom cycle and the bust cycle. This explains bubbles and crashes in financial markets. Application number three, application to financial markets. Investors' biases lead to mispricings, which then influence the fundamentals of the assets they are trading. Investors' biases lead to mispricings. I don't know if it's because that value they invest, does that lead to mispricings? Instead of markets being purely efficient, as traditional economics suggests, markets are often irrational because perceptions drive prices. Example in financial markets, investors believe a certain asset will rise in value, while during a stock market bubble. Example in financial markets during a stock market bubble. Investors believe a certain asset, for example, tech stocks, will rise in value. That's a stock bubble. So they have a belief in the future of some sort of stock, and so they invest in it. So that's creating a bubble. Number two, their buying activity pushes prices up, reinforcing their belief. So if they keep buying, there's not a lot, so it raises prices, reinforcing their belief. More investors jump in, further inflating prices, which is a self-reinforcing loop. When reality fails to match expectations, for example, poor earnings reports, panic selling begins. Prices collapse, reversing the cycle, which is self-correcting loop. Beyond markets, reflexivity in politics and society. So George Soros also applied reflexivity to politics, democracy, and social change, arguing that public perception shapes policies and vice versa. If people believe a leader is strong, their support reinforces that leader's power. If confidence erodes, that leader's power weakens, often creating a self-fulfilling prophecy. So why does this matter? Soros' reflexivity challenges the assumption that markets and societies move toward equilibrium. Instead, they are dynamic systems where perception and reality constantly influence each other, leading to booms, busts, and social transformations. Remember, so let me go back here. What is it? And because right here on my notes, I have efficient market hypothesis versus theory of reflexivity. So that idea that he doesn't believe. So there's like a saying, like a true economist believes, a true free market economist believes that if you just let the market play out, prices will reach equilibrium. People will, if somebody makes a good product, if there's competition, people will tend to want to buy that which the producer is incented to make a good product, because the market will decide whether it wants it or not based off the quality of that product, right? So if I have two businesses and you let them compete, the one with the better product is gonna people are gonna want it more, and the price it'll be more valuable because of its maybe rarity, etc. And then there's a market for inferior goods, right? Goods that are necessarily not as expensive. Sort of in America, it's like the Chinese product is inexpensive. It's an inferior good to a more brand loyalty driven product, that is more expensive. And so, but that's what people believe, that the market will play out itself if you just leave it alone. It'll correct itself. That's kind of what we're thinking in America. If we just allow, if we, things are expensive right now, but our economy is healing from this uber inflation, this superfluous inflation, this superfluous amount of printing of money. And so it's killing our dollars. That's why Trump is bringing investment money that's already out there, bringing it here instead of just printing money out of thin air, which is, it's just the increase of monetary growth is the cause of inflation. And so he doesn't believe this. What is efficient market hypothesis? So the efficient market hypothesis is an economic theory that suggests financial markets are informationally efficient, meaning asset prices always fully reflect all available information. This implies that it is impossible to consistently beat the market because prices already incorporate all known data. So key assumptions of EMH: rational investors, market participants act rationally and immediately adjust prices based on new information. Random price movements: since new information arrives unpredictably, stock prices follow a random walk, meaning past price movements cannot predict future prices. No arbitrage opportunities: any mispricings are quickly corrected as traders exploit them, keeping markets efficient. So, three forms of efficient market hypothesis. Economist Eugene Fama, 1970, classified EMH into three levels: weak form efficiency. Current stock prices reflect all past price and volume information. Technical analysis, also called chart patterns, is useless because past trends do not predict future prices. Fundamental analysis, studying financials, may still provide an edge. Semi-strong form efficiency, prices reflect all publicly available information, including news, earnings reports, and financial statements. Semi-strong form efficiency, prices reflect all publicly available information, including news, earnings reports, and financial statements. I already read that, right? Neither technical nor fundamental analysis can consistently outperform the market. Only insider information can provide an advantage, which is illegal, right? Strong form efficiency, prices reflect all information, both public and private, insider information. Even insiders cannot gain an edge since prices instantly adjust to new data. So, implications of the efficient market hypothesis: active management. Stock picking is largely ineffective as markets quickly adjust to new information. Passive investing, index funds, is the best strategy since beating the market is extremely difficult. Market anomalies like bubbles shouldn't exist if markets are fully, so this is where he disagrees. Market anomalies like bubbles shouldn't exist if markets are fully efficient. This is where critics challenge EMH. So criticism of efficient market hypothesis: market bubbles and crashes. Events like the dot-com bubble in 2000 and the 2008 financial crisis suggest that markets can be irrational and inefficient. Behavioral finance: investors are not always rational. They exhibit biases like herd behavior, overconfidence, and panic selling. Remember, the market participants, right? The perceptions that people bring. Behavioral finance: investors are not always rational. They exhibit biases like herd behavior, overconfidence, and panic selling. The last one, criticism of EMH: evidence of market beating. Some investors, like Warren Buffett, have outperformed the market over long periods, challenging the idea that stock picking is purely luck. EMH versus Soros reflexivity. While EMH assumes markets are efficient and reflect true value, Soros reflexivity argues that markets are influenced by perceptions and biases, leading to cycles of booms and busts. Okay. Um, so market fundamentalism, because he talks about this, him not really agreeing with this. So it's probably this market fundamentalism probably goes against his idea of reflexivity. What is market fundamentalism? Market fundamentalism is the belief that free markets are always the best way to allocate resources and solve economic and social problems with minimal or no government intervention. It assumes that markets are self regulating, efficient, and lead to optimal outcomes when left to operate freely. Key ideas of market fundamentalism: markets are rational and efficient. Prices reflect all available information, hence the efficient market hypothesis. Markets naturally correct themselves without the need for government interference. Um, so another idea of market fundamentalism: limited government role. Regulation, taxation, and government spending distort the efficiency of free markets. Public services, healthcare, education are best provided by private entities. Privatization and deregulation. Governments should privatize state-owned industries to improve efficiency. Deregulation fosters competition and innovation, benefiting consumers. Trickle-down economics. Lowering taxes on businesses and the wealthy promotes investment, economic growth, and job creation. Wealth trickles down to lower-income groups through increased economic activity. Yeah, but I think that also works when you kind of really tighten up who you allow into the country. So you allow those. Remember. So then that's a perception that I'm giving off. The idea that I perceive, if we just allow people to come in, it's going to keep you're always going to have the cheapest labor force you can, and you're constantly going to sweep people that have been here that should be taken care of under the rug. They're going to get left behind by people who just get here and have their own perception of necessity. They have to work, so they're going to take those jobs, even if they're not legally here. So criticism of market fundamentalism. Market failures. Markets do not always allocate resources efficiently, e.g., financial crises, environmental destruction, healthcare inequality. Externalities such as pollution require government intervention. Income inequality. Unregulated markets tend to concentrate wealth, widening the gap between rich and poor. Still have that today. Even with government trying to create a centralized unit of power. So income inequality, I already did that. Short-term focus. Profit-driven markets may prioritize short-term gains over long-term societal well-being, e.g. climate change, workers' rights. Boom and bust cycles. Critics like George Soros argue that market fundamentalism ignores reflexivity, which causes speculative bubbles and financial crises. Example, the 2008 financial crisis was partly caused by excessive faith in deregulated financial markets. So comparison between market fundamentalism versus reflexivity. Markets, so right now I'm gonna go first. When I go one, I'm gonna go to two, and one being market fundamentalism, and then number two, Soros reflexivity. So first, market fundamentalism. Markets are self-correcting and always efficient. Reflexivity. Markets are shaped by perceptions, leading to booms and busts. So market fundamentalism, which we consider to be free market capitalist, markets are self-correcting and always efficient. Soros's reflexivity, markets are shaped by perceptions, leading to booms and busts. Back to market fundamentalism, government intervention distorts markets. Reflexivity, markets can be irrational, requiring some regulation. Back to fundamentalism, prices reflect true value. Reflexivity, prices are influenced by biases and speculation. Back to market fundamentalism, free market capitalism leads to prosperity. Soros reflexivity, unchecked markets can cause crises and inequality. So actually, George Soros, in his book I just read, he says that market fundamentalism shares an idea with Marxism. Let me go back and read it. And I highlighted it. I highlighted everything. So that financial markets do not tend toward a rational expectations equilibrium. Okay, so he says its dominance cannot be compared with the paramount position that Marxism used to enjoy in the Soviet Union because the United States is a democratic country. But the two ideologies have one feature in common. He's talking about Marxism and laissez-faire, that they both base their claim to validity on the authority of science. They both claim their validity. So Marxism and laissez-faire both claim their validity on the authority of science. Market efficient market hypothesis, theory of reflexivity. Um, so he says that he feels like market fundamentalism is more dangerous than Marxism, which I don't know. I'm not sure. Laissez-faire. I'm on internet. So laissez-faire is a French term meaning let do or let it be, referring to an economic philosophy that promotes minimal government interference in markets. It is a key principle of classical liberalism and free market capitalism. Free markets operate best without government intervention. The economy functions most efficiently when left alone, guided by supply and demand. Government regulation, taxes, and subsidies distort natural market forces. So government regulation, taxes, and subsidies distort natural market forces. Individualism and private property. Economic success comes from individual initiative, entrepreneurship, and competition. Private ownership of property and business leads to innovation and economic growth. The invisible hand, Adam Smith's concept. In The Wealth of Nation, Adam Smith described the invisible hand where self-interest drives economic prosperity. Individuals pursuing profit unintentionally benefit society. For example, a baker making bread for profit also feeds the community. Opposition to government control. No tariffs, price controls, or wage regulations. No government-owned industries. Privatization is preferred. Um, Laissez-faire in action. Historical examples: the Industrial Revolution in the 19th century, the Gilded Age, the late 1800s in the US, and Hong Kong's economy post-World War II. So Hong Kong's economy under British rule, Hong Kong had almost no economic regulations, leading to rapid growth and becoming a global financial hub. Um, they had no economic regulations. In the Gilded Age in the late 1800s in the US, minimal regulation led to the rise of monopolies. Standard Oil, Carnegie Steel, eventually antitrust laws, the Sherman Act, were introduced to curb corporate power. Um, Mark Twain wrote a book about the Gilded Age. It's a novel, but supposedly there was a lot of greed. So the U.S. and Britain embraced laissez-faire policies, leading to rapid economic growth, but also poor working conditions and inequality. This is the Industrial Revolution in the 1800s. So criticism of laissez-faire economics. Market failures. Unregulated markets can lead to monopolies, income inequality, environmental damage, and financial crises. Worker exploitation. Without labor laws, businesses may prioritize profits over fair wages and safe conditions. Boom and bust cycles. Lack of oversight can create financial bubbles that burst, like the Great Depression and the 2008 financial crisis. The Great Depression was 1929. Um, so laissez-faire versus market fundamentalism. Laissez-faire is a broader philosophy of minimal government in the economy. Market fundamentalism is a stronger belief that markets always lead to the best outcomes, even when evidence suggests otherwise. Market fundamentalism. So laissez-faire, right? Like so it's a French word, so let do, let be. Yeah, let do, let it be. Like with no government intervention, totally free market, unregulated. Um so what did Soros mean when he said financial markets do not tend toward rational expectations, equilibrium, equilibrium? What did Soros mean when he said financial markets do not tend toward rational expectations equilibrium? Um, he was challenging the idea that markets are always efficient and self-correcting, breaking it down. Rational expectations equilibrium. In traditional economics, like the efficient market hypothesis, markets are assumed to move toward equilibrium because all participants act rationally, processing all available information correctly. Prices should reflect true fundamental values, and any deviations, bubbles, or crashes should be corrected by rational investors. Soros' argument, markets are not rational. Soros, through his theory of reflexivity, argues that market participants are influenced by biases, emotions, and flawed perceptions. Theory of reflexivity. I want to talk to my teacher about that. Instead of moving toward a stable equilibrium, markets often overshoot in both directions, leading to booms, bubbles, and crashes. So, theory of reflexivity, that market participants are influenced by biases, emotions, and flawed perceptions, um, often leading to booms, bubbles, and crashes instead of moving to a stable equilibrium. Feedback loops create market instability. Market prices influence fundamentals, and fundamentals influence market prices in a self-reinforcing loop. For example, during a stock market bubble, investors believe prices will keep rising. They buy more, prices rise further, their belief is reinforced. This feedback loop pushes prices away from any rational equilibrium until the bubble bursts. This explains events like 2008 financial crisis and the dot-com bubble. Soros versus traditional economics. So we'll go from traditional economics to Soros reflexivity. So the rational expectations equilibrium, which is the traditional, and the EMH, which is the efficient market hypothesis. Markets are rational and move toward equilibrium. Reflexivity believes markets are driven by biased perceptions. Prices reflect all available information. Prices are influenced by investors' flawed beliefs. Corrections happen quickly, no long-term bubbles. Markets can remain irrational for long periods. Crashes are caused by external shocks. Crashes are caused by self-reinforcing cycles. Why it matters? Soros' view suggests that markets are inherently unstable and government intervention may sometimes be necessary to prevent destructive cycles. This is a key criticism of laissez-faire capitalism and market fundamentalism. So, globalization of financial markets. The globalization of financial markets refers to the increasing interconnectedness of financial systems across countries, allowing for free flow of capital, investments, and financial services across borders. This process has been driven by technological advancements, deregulation, and economic integration. Free flow of capital. So, key features of financial market globalization: free flow of capital. Investors can buy and sell assets in global markets without major restrictions like stocks, bonds, currencies. Examples: US investors can invest in Chinese stocks, and European banks can lend money in Latin America. Integration of stock and bond markets. Stock exchanges and bond markets are increasingly interconnected. Events in one country, for example, US Federal Reserve interest rate changes, affect markets worldwide. Cross-border banking and investments. Multinational banks and investment firms operate in multiple countries. Companies raise capital internationally. Apple issuing bonds in Europe. Technology and financial innovation. Electronic trading platforms and fintech make it easier for investors to trade globally. Cryptocurrencies and digital assets are part of the new wave of financial globalization. Hedge funds and speculation. Large hedge funds and institutional investors move massive amounts of money across markets, influencing currencies, stocks, and bonds worldwide. Hedge funds and speculation. Large hedge funds and institutional investors move massive amounts of money across markets, influencing currency and stocks and bonds worldwide. Um, Benefits of globalized financial markets. So benefits of globalized financial markets: increase investment opportunities. Investors can diversify portfolios across different countries. Efficient capital allocation, money flows to where it can generate the highest returns. Lower borrowing costs, countries and businesses can access international financing more easily. Economic growth, developing countries attract foreign investment, boosting their economy. So risk and challenges. Financial crises spread faster. Example, the 2008 financial crisis in the US led to a global recession. Capital flight, investors pulling out money can destabilize economies. Speculative attacks on currencies. Example, George Soros bet against the British pound, forced the UK out of the European exchange rate mechanism. One guy did that. George Soros bet against the British pound, forced the UK out of the European exchange rate mechanism. Income inequality and volatility. Speculative capital inflows and outflows can create economic instability in developing countries. Wealth is often concentrated in financial centers, Wall Street and London. Loss of economic sovereignty. Governments may lose control over monetary policy due to dependence on global capital flows. Countries may be forced to follow IMF or World Bank policies to attract foreign investment. So loss of economic sovereignty within a country. So loss of power, really. Globalization and Soros reflexivity. So Soros argues that global financial markets are prone to booms and busts due to reflexivity. Investors' perceptions influence markets, leading to cycles of excessive optimism and panic. Example, the Asian financial crisis in 1997. Massive capital inflows created an economic boom, but once investor sentiment changed, capital fled, causing a crisis. So the main thing is like just the deregulation of the movement of money. People could go and just invest and make all they want and then just bail out and leave that economy just dead. So things that I've heard about Soros kind of make it seem as if he's hypocritical. Like he uses this globalization in a sense. If what he so he bet. I'm gonna do another video just briefly going over how he bet on the pound in 1992. It says George Soros bet on the pound. He bet against the British pound in 1992. And I want to do another video and put it together, guys. I have two other things I want to mention. Soros' human uncertainty principle and the theory of perfect competition. I guess I could do another video. I'll just do another video. Peace, y'all.